Okay, it is Monday, the 15th of January 2024, and we're going to have a look at the calendar ahead. Then we're going to look at a couple of macro items that could have and probably will have a lot of market impact. And then we're going to look at some economic charts and then straight on to the futures charts. So here we go on to what we're looking at for this week. Today, Martin Luther King Jr. Day, holiday in the States, quiet volumes on equities. We're kind of range bound on the SPOs and the Dow. Tomorrow, German CPIs, not much of a party there. Wednesday, CPIs out of Europe, which will be interesting to see if it's kind of moving around in line with the US. Really want to see how the European picture is shaping up inflation-wise. But then we're going on to core retail sales Wednesday and retail sales at 1:30. Obviously, we'll have DOE for the oil traders. Thursday, initial jobless claims. This is going to be the best day to trade, I think, for volatility here. Initial jobless claims, big component for the Fed to be looking at and traders to be looking at here in terms of GDP and the whole macro picture when we try and figure out how likely are the Fed to do what is now 7 in a row cuts this year. It moved at one point last week because of CPIs, coming into CPIs and after CPIs, but coming into CPIs it had priced in a rate cut at every meeting, which I think is 8 or 9 meetings this year. Anyway, 55 manufacturing. Crude oil. I got it wrong. Crude oil is on Thursday because of the Martin Luther King holiday on Monday, and then Friday existing home sales. So an interesting enough week, but coming through on the tail there. So Wednesday and Thursday are actually going to be the best days to trade this week. All right, getting on to some of the macro, what's going on. The oil tankers diverted, more oil tankers diverting from the Red Sea. The UK has struck some Yemeni targets over the weekend, and this is really just there's Maverick taking off on the ship, going off to battle, I don't know, whoever anyway. A bit of Top Gun going on here in the Red Sea. Have a read of this article because it's really an escalating situation here that we need to be mindful of. Now you could say, well, yeah, fine, let's look to buy oil on the escalation of this. And I do want to talk about that when we look at the oil chart, but essentially these oil supply risks priced in and out very quickly and a lot faster than you would traditionally think. So for example, over the Gulf War, the risk got priced in and out within a sort of a 30 to 40 hour period. Okay, so if you're the day after and it's the pit session the day after, or it's the close of the pit session the day after a trading day that this is in the market, i.e. 2 trading days after it is known, you are on the wrong side of the trade getting long there. If anything, it's going to price into the downside and then potentially reprice a further escalation of a war risk or a supply risk. So we're coming down. Who knows why we're coming down or going up in any asset at any given time, but oil is definitely a mire of macro reasons. So have a read of this anyway. What is interesting is that we have let me pop a map open here. Let's get to the maps here and look at the Panama Canal. All right, so on one side of the globe you've got the Suez Canal, and then on the other side of the globe you've got the Panama Canal. So Suez is over here, right over here, and the Panama over here, right? And so obviously we know this is a problem here in the Red Sea, in the Red Sea here, right? And this is for flows coming from China into destination Europe, North Africa, right? But more so destination Europe, okay? Over in the Panama Canal, they have their own problems here in that the water levels in the canal, there's a drought, and so they're not able to get as many ships through. And reading on this article, it's actually 55% of capacity. See here, operating at only 55% of normal capacity, according to Capital Economics. Now, what I like about this article as well from FT, this is free to read even if you don't have a subscription here, but what I like about this is that this shows where we are in terms of standard deviations from the mean, and we can see it back as far as 2019 freight rate prices here. Well, this is global supply chain pressure index. This is basically freight prices and how it's deviating from the mean. The mean here down at 0. Obviously, we had this huge deviation to the upside, 4 deviations to the upside over Ever Given blocking the Suez, Russian invading Ukraine. We kind of come off then back after that. Now we dipped, kind of bottomed out. I remember talking to one of the traders here in a pub in London about saying that the freight rates I thought had bottomed. We were talking about an investment investment in Zim, and he seems to think that they have more to go. I think let's see if we get one deviation again on this to the upside. I think my thesis that we have bottomed out on rates is come true. But for now, I could see why we could have easily gone further off to the downside, but we were below one deviation below the mean pricing, 2019 pricing, when I was kind of forecasting that. I thought we had kind of bottomed out on rates. Anyway, this is a really interesting chart. Where do I think this is going? Who knows? It depends on if this escalation gets, or if there is an escalation of this situation in the Red Sea. I think there will be. I think we'll be back up to 1 and 2 deviations within probably 6 weeks here on this, given that we have the situation in the Red Sea and in the Panama Canal. So little article here I got from the letter from John Kemp, who is the senior energy journalist in Reuters. Really just looking at massive LNG oversupply. Now, it's kind of hard to marry this with where prices are on nat gas, Henry Hub nat gas at US, currently trading 142 on the February futures, and it's had a hell of a month. It's up like 50% since December. So that doesn't really marry in with we have this huge oversupply hanging, waiting to fall down on us. But interesting to keep up with that if you are a nat gas trader. Going back to one of the stories that we were looking at last week, Boeing, this is getting worse and worse for Boeing. Now, we talked to one of the traders in here who is based in the UK and is an aircraft engineer, sort of a senior aircraft engineer, been at it a long time. And he was saying that this is potentially either one of two things. It's an isolated incident to this aircraft we're looking at here, or this is a sort of a design malfunction on the 737 model. So all of those aircraft, wherever they are in the world, have this fault and will need to, essentially, they need to do a recall, right? So, we have the captain's hat on for various reasons, the hijinks on the high seas in the Red Sea and hijinks in the skies. So I thought this is a good article. It is firewall blocked here, but we're down on Boeing. We looked at that chart and it's got a long way to go to the downside, 130s, I reckon, and lower. But this is really bad for Boeing, saying it's been going on for years. And I just think they're headed to zero ultimately as an airline, or sorry, as a manufacturer of airlines. I don't know. Something's got to get fundamentally changed here. All right, moving on to the economic situation here and sort of looking in the markets as well. What you're looking at here is the flow of funds into money markets and money market funds. Now, what are money markets? Well, money markets are essentially a safe way to park money and get an income against it, but you're not really looking to have capital appreciation. So if you have £1 million, or well, if you have any amount of money, really, I mean, this applies to people who can buy US treasuries, T-notes, bonds, all that stuff. But let's take, for example, an asset that a money market fund would own, the US 12-month bond, okay? The 1-year bond. Currently, it's, actually, I've caught myself on the hop here. I'll just look up what the actual rate is at market right now for the 1 year, and it is, let's see, the 10 years at 3.94 US. Here, let's have a look at this. 12-month is currently paying you out 4.6%, okay? So the 12-month, anything under a 13-month duration asset can be bought by a money market fund. And we've seen since the Fed started raising rates, this huge inflow into buying these bonds. Why? Because essentially on the 3-month note here, you can make 5.35%. All right, 5.35%. That's insane. All right, that's a great return. I'll just pop it in here. You can see that on the 3 months, you're getting 5.35% back on your money and your money back. All right, so you're generating an income against that resting cash in your account, all the way up to the 12-month paying out 4.66%. Okay, so this is the front of the yield. This is sort of the mid to back of the yield. Or sorry, this is kind of still the front of the yield on the 12-month, and then you're looking at the back here, the 30-year paying 4.18% return, 10-year 3.94. That's T-notes right there. But just wanted to note how all this money is flowing into these great yields over since the Fed started raising rates, March 22, I think it was. And now we really just got to monitor how, as the rates come down on the 12-month and on the front, as they may get a little bit, the yields may get crushed, price up, yield down, that investors and these money market fund holders might want to get out and put that cash in towards equities and and different paying assets, corporate bonds, or who knows, but different assets. So that's liquidity really to come back into the system. What you're looking at here is 6 trillion total in there. So, is it all going to come out? No, it's not all going to come out at the same time. So we'll move on here. I thought this was really interesting, this chart here from Michael A. Arut on Twitter. This is clearly a chart from the FT. And house prices in the UK were last this expensive relative to earnings was 1876. So if you're earning money, making your wage, trying to buy a house, well, you're kind of where they were in 1876. So quite a while ago. So this is how difficult it is to buy a house right now in the UK. And it's not just in the UK. I mean, here's another chart actually from Schroders, looking at that similar picture, looking at the average earnings to house price here, the ratio, and see, confirming that really. So I'll post links to this. Added to that, it's not just the UK that's kind of got an interesting picture on the housing market, but you can also see here the shift in residential prices that we just got last week in Germany has fallen 10.2% in the third quarter 2023, the most ever since data began on this. Okay, so house prices falling. It's obviously a buyer's market. Moving on to the Kobayashi letter. I follow these guys on Twitter. Really like this. We had that CPI report right last week come out. Just a tinchy bit hot. Okay, tinchy bit hot. Where did the inflation come in? Well, it came in here from all items less food and energy, right? And so the headline here coming out, right? And so 3.9%. Now, if we look inside of that from the Kobayashi letter, you see that car insurance inflation 20.3%. I don't want a car anymore. If that's the insurance rates in the US, I don't want a car. Get me an e-scooter. Get me a bike. Get me a skateboard, man. Give me a skateboard. Also seeing car repair inflation going up here as well. Obviously, a lot of people choosing to go for the second-handers instead of the newbies, where you're getting like your service package for a year, 2 years on the new car or on the lease deal. With the second-hand cars, obviously more maintenance and people paying for that maintenance out of pocket as opposed to dealerships paying for it. Rent inflation is still on the rise here, but yeah, just transportation inflation 10.1. So just while we break down that hotly watched CPI last week, I think it's hot. Is it enough for us to keep us off of the highs? I don't think so. I think we need to hear from the Fed ultimately to have something major happen in these markets and take us off the highs. Thought this was interesting as well here. What is it? This is actually the average hourly earnings in the US since 2021, Jan 2021. So you have the nominal versus the real, which is with the real, obviously the nominal does not account for inflation. The real does adjust for inflation. And you see here that real average hourly earnings are down. And I think they're down about 0.74, actually 74 cents, I think it is, that they're off here. But you're seeing that actually, even though we have inflation and you've got a pay rise or bonuses, or pay rise really, you're still not doing any better. You're doing way worse than 2 years ago. Way worse. All right. So just thought I'd highlight that one. Okay, let's get over and look at some of these charts here today. We'll get over onto the big ones. Sorry, last week I had said we were looking at daily bars, but I actually have weekly bars up. So this week we got the daily bars. Here is the S&P 500. I was looking for selling to come in off of the non-back adjusted high 48.08. It's been a nice little level to trade off of, but you've seen we've had quite decent moves below. I think the market needs to come down to 45.86. It's got a 45.66 is actually down into these areas here to pick up really good buying, and then I think we could maybe push on. But what would that be? How big is that of a move that I'd be looking for? Well, from where we are at market, that would be about 5% down. I think that would make sense. For now, I wouldn't feel comfortable about buying at these areas. If I had a medium term outlook, I wouldn't feel comfortable about buying this for another push on. I think we need to come back to just around here. I don't think we need to go as low as 45. Where is this? Like 45.50s. You can see this line in the sand. Buyers did come in, so that for that reason, I don't think we need to retest down that low, but just a little bit above 45.80s, somewhere around there. So that's the S&P 500. Okay. Nasdaq, similar story. There's not much to talk about while we're up here. I mean, you could look at a little bit of resistance maybe to come in around here, but you're going to need a catalyst to take it down, right? And what is that going to be? Well, it's not going to come today. It's not going to come today. It's a quiet day, unless it's a macro impact catalyst, breaking news sort of stuff. But ultimately, technically, I think we need to one of these back down to the 16062s. It's not going to be 1 days of trade that'll get us down there. Ultimately, chart calculator on from where we are right now, that's going to be about 5.5% pullback. If we zoom out here, these are non-back adjusted charts in case you think they look a little bit weird. Okay, moving out on the Dow, similar situation, 37,784. Ultimately, we are in a sideways trend here on the Dow, so do be mindful of that. Let me show you this on my more detailed chart here. Do be mindful of this range here. Daily bars you're looking at here on the left. So it's really, what is it? It's about 37,660s to 38 even, about there, basically. It's the job owning that we got on the Tuesday, the 2nd of January here on the reopen. So just do be mindful. And we saw that clearly trade there on Friday last week. Clearly trade. We went to the low, we went to the high. So simple stuff. I think today, if you get a chance to trade that range, take it. I don't think we're going to have a big old day where we get bust out of the range unless it's a macro driver. Yeah. All right. So let's talk about oil. Oil. Yeah. So talking with a couple of people or back and forth, not really talking with people on Twitter, just kind of back and forth of posts about how we survive in areas like this is we spread trade. We front month spread. We do kind of go over that in the capital room, how to do that. But essentially, if you're just naked long, naked short, you are going to get eaten alive. Now, do we ever naked like outright positions with stops? Yeah, sure we do, where we're not hedging the risk, or spreading the risk. But when we should be way up here on this geopolitical risk, sure, it's a great time to put on some spreads, stay maybe overweight short, as we could see on Friday. That was quite obvious that we just could not hold above this 73.60s area, which was really good resistance before. And down we come. Now 71.60s, I think you're starting to see some buyers come back in, but this is a really key pivotal area, 71.60s for me on oil. Personally, I think at some point we are going to break to the upside, but it's really hard to see that right now. It's really hard to see that as we look to kind of trade to the bottom of this area here off of what was the top here. All right. So unfortunately, this technically, to me, if I was just pure technical trading this, we exit to the downside, because that is our mantra with these compression areas. We exit the way we come in. How do we come into this area? Moving down. All right. So how do we exit? By moving down. And you've seen a bit of a fake out on the upside here come in. So unfortunately, I got to be a slave to the technical until I see some buyers hold us at 71.60s and then rally us back up to here. But yeah, I'm just staying nimble at the moment. A little bit overweight on the shorts here on oil. Have I got anything else for you? Well, this bond trade, just want to finish off on this bond trade, excuse me, that I've been looking at for the past couple of months. And if we go to here, all right, so we have come into supports here. I think the bonds, I would be waiting to get into this trade on a really decent pullback. Is that going to be to 110s? Is it going to be to 108s? I don't really know at the moment. Obviously, I would love 108s to be buyer here on this line in the sand, and then I think that's done on yields staying high, and we're going to be back at 116s within a month or two on rates, on the bonds. But until then, I really want to see some sort of macro driver to really scare the hell out of this market, or equities have a really good push, which would probably de-risk on the bonds down. I don't really know how it's going to take shape, but I know what I want to see. I just don't know what it's going to take for that to happen. Anyway, so that's it for me for another pre-US look ahead for the week. Listen, have a great week, stay lucky, and I'll see you next time.